Geoff, it seems like whenever we talk equities, you always go over to the foreign exchange space. Bring up the chart right now. This is the delta on Indian rupee. And I just want to use this as a proxy, Geoff, for brutal moves. Are we going to see brutal moves in EM equity if we see this kind of weakness, log weakness, in Indian rupee?
I mean, the Indian rupee alone, I don't think is going to drive extreme weakness in EM equities. But obviously, the rupee is an example of what we've seen for a good chunk of this year, especially for a period in the third quarter with the Turkish lira being very weak, and also later on in Q2 as well. So our argument has always been that where the dollar goes will drive flows either into EM or out of EM. And we've had a very strong dollar this year, which has sucked money out of the emerging markets. And what that has done is picked out the weak brethren within the emerging markets with weaker fundamentals. And with the oil price higher, inflation picking up in India, that's one of the reasons why the Indian rupee has come under pressure. A weaker dollar, Tom, which is our view at UBS over the rest of the year and into 2019, this will solve all of this stuff as far as EM is concerned, because it'll push money back towards the asset class.
But, Geoff, what if, and good morning from London, what if China was slowing down to a point where China had to be inward-looking, so just focus on domestic? That would, of course, hurt a lot of the emerging markets.
Yes, it would. There would be demand impacts on a lot of emerging markets, obviously, particularly those that trade very closely with China. Countries like Korea, like Taiwan are obvious examples to that. If there were to be a sharp slowdown in China, much more severe than we're seeing right now, that would, I think, put the whole of the asset class under pressure. There's no doubt about that. That just happens not to be part of our scenario. We did cut our growth forecast for next year yesterday from 6.2 to 6% on the back of the latest tit for tat moves on the tariff front. But we still believe overall that China is slowing in a controlled way. The soft landing, if you like, continues to play out. And the authorities in China have got room to ease policy at the margin, or perhaps one should say reduce the pace of tightening at the margin, which will support the economy. So a crash in China will be very, very unhelpful, but we just don't see that happening, frankly.